Hi, everybody. Welcome back to the Love Podcast. We are excited today to have with us John Sanfilippo as well as Jamie McGrory. Uh, now, John, I understand you're the CEO and founder of My Choice. Maybe you could give a little bit of kind of a brief introduction, and then I'll move over to Jamie and let Jamie do his introduction.
Yeah, sure. Yeah, so I'm the CEO and founder of Your Choice Financial. It's an independent RIA that was started out of Orlando, Florida. We've got locations in multiple states now. We help clients all over the country. Been in the industry for almost 18 years. It's the only thing I've ever done with my finance degree. And really looking forward today to having a fun conversation.
Yeah, that's great. I appreciate it. And Jamie, this isn't your first time here. Glad to have you back.
Thank you. Yeah, so my name is Jamie McGrory. And this is my 40th year in both the insurance industry and since graduation of law schools. It's been a lot of different capacities within the financial services industry, from director of regional director of estate and business planning. I was vice president of agencies at a major carrier and ran successful agencies for a carrier. So one of the things I wanted to do as we move forward is to help individuals in a way that we can have an open architecture for them. Well, we created Love Financial, which is I'm a co-partner within that, and that's who I am.
I think it's fantastic that we have a lawyer that's been in this space for a long time, along with a registered investment representative that really understands the market. And I know our audience has been really asking me a lot of questions regarding estate planning and some of the current topics today. And one of the things that keeps coming up is life insurance. And we all are inundated with ads, either online or through the direct solicitations, and a lot of people are confused about, where life insurance should fit in their life, especially, our audience spans the range from people in their 20s all the way up to, past retirement age. And so I know life insurance impacts people at different stages in their life. But I thought maybe we could start off by, first, what is the difference between term, universal, whole life, and kind of all these things that we're hearing about. And I guess there's even maybe some other types of life insurance now that are hybrids. So I guess I throw this question out to John. Maybe you could give a little bit of an overview of kind of the different types of insurances.
Yeah, so I would look at life insurance, I guess, compare it to some other things that we have, such as cars and homes, right? So if you think about term insurance is you're going to pay a little bit of premium for a large amount of coverage, which they call death benefit, right? And really all that means is that that's the check that's going to get delivered to your spouse or to your family if you pass away. So within a term policy, it's kind of like you're renting a car for a certain period of time. You pay a premium. If you don't pass away after a certain amount of years, 10, 20, 30 years, then the insurance is gone, but you have no more premiums. Okay. Where a permanent policy is more of you pay a little bit of premium that is more than a term policy, but you still get a very large amount of death benefit. And now you're going to have that policy for your entire life. Now, the difference between the two of them is you have it for your entire life, but also there's a third component on most of the policies, which is a cash value component. That cash value is almost, think about it's like another savings account, which can either be fixed, it could be variable, it could just be like a combination, like where it's like an index play. But now you would have that policy for your entire life. So what we like to tell our clients is look at only term and permanent. Inside of permanent, there are, a dozen or so different types of policies. Some are more risky, some are more conservative, and they really need to be designed based upon everyone's personal situation.
Okay,
Part
that's
yeah,
right.
part of the way that insurance works is that life insurance does not create wealth; it replaces loss. So if you think about it, it's what happened on September 11th when there were a lot of claims that put in. How did they calculate and figure out the insurance basis for what an individual so-called is worth? So there is a number that is put together based upon your specific situation, and that's the number that would be your replacement cost. So if you want to take the emotional side out of it out, everybody has a replacement cost in dollars and cents, and that's the total amount of insurance that you can get. So the insurance companies, by charter, cannot create wealth. They can replace loss. And that's the financial loss. So insurance is, as you look at it, that is the reason for insurance.
That's really interesting. I never thought of it that way. That I think a lot of people just look at it as I want to leave something behind to my heirs, but it's not intended to create wealth out of nothing. That makes a lot of sense. And I guess that's where actuarial science comes in, correct? These
Yes,
are the guys that are trying to figure out what you're worth and what your earning potential was over your lifetime, and put a number on it and try to
correct.
figure out how long you're going to live, correct? So now that we kind of established what the different types of insurances are, I get a lot of questions around, do I really need life insurance? Depending on, again, our audience has ages all over the place. And I understand that the estate tax burden on estates is not bad here in the US. I think it's $15 million per person. And if you're married, you have up to a $30 million exemption. And I know in the old days, life insurance used to be sold as a way to cover your estate taxes in the event you die. So you could pass on, for instance, if you owned a family farm or a family business, you don't want to have to liquidate the business or liquidate the farm just to cover the estate tax. And so that was a really compelling reason to have life insurance. But how do you view it today, given the high estate tax deduction that's available?
So, putting aside the subset of the population that would still have an estate tax, right, because of their higher net worth, people that are under that federal exemption, I think there's a couple of things that they have to be looking into. Number one is you have to be looking at your local state. Are you exempt from your actual local state's estate tax? Because those numbers are much different than the federal number. So we have a client right now, as an example, lives in New York, not in a federal estate tax issue, but has a New York State estate tax issue. So that's, definitely look at your local state and understand what's going on there. It's something that we do can calculate to see if there is an estate tax problem from that perspective. The second part of that I'd also say is for individuals that don't have an estate tax issue in federal or state level, they have concerns that they have to think about in their personal life, right? So we've got a generation of people who've put away a ton of money into 401ks and IRAs because that's what they've been told they need to do. They've put away $1, $2, $3 million into IRAs, and now that money's got to transfer to the next generation, right? And or transfer to their spouse. So what most clients, in our opinion, are not really considering is the tax impact that has. So, I mean, it's something that, you definitely want to talk to your CPA or your accountant to get their exact numbers because they're the ones handling your returns. But right now, most people, if you're just going to transfer that money to your spouse, you're filing your tax return as a joint married couple, right? So you're in a good, favorable tax rate. Well, let's say when you pass away, but now that IRA transfers over to your spouse, well, now they're taking it as a single individual after the 2-year exemption as the widow tax rate. So now typically they're in a higher tax bracket than what they were previously. So that impact can have a lot more, that could have a substantial impact on their lifestyle. So a lot of times life insurance will be used to kind of supplement that because now there's debt that maybe needs to get repaid from a mortgage perspective, or they might have assets that are illiquid, right? Real estate, things along those lines. And now you need some liquid cash to help supplement the lifestyle that at one point when you both were married and you both were living, there was no issues. For the next generation is a huge impact that we see is because a few years ago, they got rid of the stretch IRA, which we used to be able to say if, me as a father of 4, I could give my IRA over to my kids and they could stretch out that payment forever and they wouldn't have to pay a lot of taxes on it. Well, that's no longer the case. You have to take that money out within 10 years. So now your children may be paying it at a higher tax rate and possibly the highest tax rate. So for a lot of our clients, what we found over the years is they've turned around and said, I've worked way too hard for this money. I've saved my hard-earned money. I don't want the government to get any more than what they need to get. So for a lot of times we've looked at that. We've looked at transitioning that money from IRAs to Roth IRAs. And some of the positioning that we've done is using life insurance to help pay that tax because of what you have to face at some point in the future.
And I think
That
part of
makes a
what
lot of
John,
sense.
yeah,
Yeah.
I think what John is really pointing to is the benefits of life insurance to help supplement this. But one of the real basic, most important aspects of life insurance is that life insurance, when paid out as a bet to the beneficiary, is income tax free. So you take a look at it. So if you have $1 million policy and different ways to structure it, but if your $1 million policy is paid to a beneficiary, they get the $1 million income tax free. So it's really one of the core basics and core principles of having life insurance to be able to utilize that in the way that John was talking about it.
No, that makes total sense. And America is a country built on small businesses. And I think a lot of small business people don't really have a good handle on what their business is worth, number one. Um, and they're operating it on a day-to-day basis. And if somebody were to pass away, one of the principals passes away, all of a sudden the heirs have got to deal with this business. And that may mean that they have to hire somebody, or they may have to hire a banker to liquidate the business, or cover payroll for an extended period of time. So I imagine in that kind of scenario, which affects a lot of people. I mean, millions of people in this country are small business owners. Life insurance would be critical to make sure that there's continuity, right? In terms of running the business and
Well,
protecting the family.
so yeah, 100%. I mean, look, a great example of that would be is take a business that is successful and the owner is making money, the family's earning, living that income, and everything's all good, right?
Right.
Well, now that owner passes away, so now someone needs to step up and help with the business. How, can that person do it, right? Do they have the expertise? Do they have the time to do it, right? Because it's a big time for the rest of the family. So insurance can help bridge the gap for what is needed there. But then the second part of it also is now, I had this conversation with some clients a few years ago. If the husband was the key person into the business, he was the one doing all the negotiation for all the sales deals. Well, if he passes away, even though his wife was involved in the business, she said, well, everyone's now going to take advantage of us because they know he's not there. So now the value of the business is affected potentially negatively. So she's like, well, maybe I'll sell it, but I can't sell it really fast because everyone's just going to want to give us a lower valuation because they know we just lost a key person. So there's a lot of emotional variables that I think a lot of times we don't consider when we talk about owning a business and it's a family run business. But life insurance can be a positive tool to help bridge a gap. Because again, it's an insurance policy. Just like you have your property insurance or your car insurance, if you have an issue, it's there to solve a problem. I think what's happened over the years is it has a lot of negative conversations around it because of the way that it's pitched as just a number instead of actually how it solves the particular problems that an individual may or may not have.
One of
Yeah,
the
that's an
things,
excellent way to look at it,
yeah,
for sure.
one of the things that you also want to take a look at is to how to get the true valuation of that business. Because what happens? Well, there's your valuation as the owner and what you think it's worth. Someone out there who thinks what they would like to buy it for, and then you have the IRS telling you what they deem it to be in terms of having to file a estate tax return. So you really, in the way that we look at best practices, would be to get a third party that's not interested to be able to do a valuation on your business. And you would do that on an annual basis. And I know John's firm has a way that they can do that with some of the carriers and all that doesn't cost the client any money to do that. Now, once you have that number, that's the number you need to deal with because that's the number that's going to be pegged onto your estate tax return. So when you're dealing with death and you're dealing with businesses, you don't want the business to die with the owner or the business to die with the individual who passed. So that's just the best practices rule.
Yeah, that makes a lot of sense. And, you know, I am curious because today, the younger people in particular, but even people my age, which isn't that old, I hope, are starting to add crypto to their portfolio. And that's a very interesting asset class because, for instance, with the Love platform, you can store your crypto passphrase, and if something were to happen to you, you can pass it on to your chosen beneficiary. But what are the tax implications of crypto in terms of death in passing that along? And does life insurance play a role in that as well?
So crypto is it's an interesting one for us as a firm. We've actually made a decision that we don't, with all of our custodians that we use, we don't actually manage any direct crypto. We might have like a Bitcoin ETF that's public markets, but we don't do anything directly with crypto. So from a tax perspective, I would always say, I would tell our clients, we have a few of them, to go find, and we've made some relationships with a couple of CPAs or accountants that are experts in that space, because not every accountant understands that space and the intricacies of it, right? But from a life insurance perspective, I would look at it as every other asset that you would have in your investment portfolio. So there's really not a big difference from a tax and or investment perspective of a crypto and an ETF or a stock portfolio that you would have. You're going to have to deal with capital gains. You have potentially a step up in basis. You're going to have a lot of those same things. So we tell our clients not to look at it very differently. It's really just as a part of your overall investment portfolio.
Gotcha. No, that's helpful.
Yeah, but
Um,
this is the danger, okay? Is that you have an individual who passes, and this is where your digital vault comes into place. So they have more than $15 million, or they have more than whatever the amount is going to be at that point in time, and they pass away, and they pass away with their code to get into the vault, into their Bitcoin aspect, right? The value of that for the government doesn't change just because the heirs cannot get into and own Bitcoin. It's owned by that individual. So you're going to have a
so whether
tax.
they can use it or not, they have to pay the tax
It's
on
going to
that.
be, it's within the, if they can't use it to pay the tax bill that's due, what do you do? Right. So everything else has to be liquidated. So the critical part is when you want to put in safety nets is to be able to use your vault to be able to put in the passwords so that individuals who you want to have the funds for can access it, whether it's to pay taxes or just to inherit it. Right. Otherwise, it's
It-
sitting there and it's on your balance sheet, but you can't access it.
yeah, absolutely. I mean, that's the thing about crypto that a lot of people don't understand. If somebody were to pass away and there's a bank account, eventually the heir can get a power of attorney, walk to the bank, present that, and get access to that account. That doesn't work with crypto. Crypto is completely based on a passphrase. And if you don't have the passphrase, you don't get the crypto. And the last number I heard is $660 billion is forever lost. And that's why one of the key features of the Love platform, not to overly pitch Love here, is that you can escrow your passphrase and make sure it gets to who it needs to after you pass away. You don't want anybody to have it while you're alive, because if they have your passphrase, they can access your crypto and take it. So it's something you want to make sure you pass along after you die. The other question I get a lot, and I know we're running up against the clock, so I'll only ask a few more questions. But the other question I get is, the insurance industry has been really active lobbying the government and has gotten certain features that have been mentioned throughout this. But I was hoping that one of you could really speak to what is the carve out that life insurance has from taxes, from the way that the underlying cash value can accumulate, and what is the advantage of life insurance that it has over other types of investments?
Sure. So the permanent life insurance policies that we were talking about before that have a cash value component to it. Well, let me take a step back. Whether it's term or a permanent policy, as Jamie mentioned before, the death benefit, the check that goes to your family if you pass away, that's 100% tax free, right? On those permanent policies, that cash value component, you get to take advantage of Internal Revenue Code 7702A. I'm not again, I have from a compliance perspective, I'm not an accountant, but everyone can look it up on their own. And that code, what that allows you to do is put away money after tax. You're allowed to defer any taxes on the growth of that money. And then as long as you follow the rules of the code and of the policy, you can take money out tax-free in the future as a part of, cost basis distributions and policy loans. Okay. But so in essence, without trying to oversimplify it, it's in a way that it can work very similar to a Roth IRA. The only
Okay,
difference would be for younger people, which is really nice, is that you can have access to that money before age 59 and a half if you needed to. But you
without
have
a
to follow the
penalty, correct?
rules. Otherwise, it becomes a taxable account.
I think it's in simplest terms for term insurance, that it's for your beneficiaries. In permanent policy, you could be the beneficiary of your own policy. It's not a use it or lose it scenario, right? So, and the benefits that are there as you as an individual, there's an awful lot of benefits, but you need to speak to a professional to know what those benefits could be based upon your specific situation.
Yeah, that's helpful. I know that even in my own life, um, is insurance accessible to people of any age, or is this something you should do when you're younger, and just keep paying for it? I know I'm guilty of this. I've had term life insurance in the past that I've let lapse because of whatever hardship was going on in my life at that point in time, and I regret that now because I know insurance gets more expensive as you get older. But maybe you guys could give some guidance as to who's this a fit for? Is there any kind of rule of thumb you should look at in terms of the amount of insurance you get? Just some basic kind of advice you would give your clients.
Sure. So I guess the easy salesperson thing would say that everyone's a candidate for life insurance, right? But I think what you have to really look at it is where we would try to take a step with each one of our clients is building a customized plan for them. We wouldn't want to look at insurance just in a silo of just saying, hey, let me get you insurance. We have to look, what's the reason why? Where is the risk? What is the gap that we're trying to really fill and solve, right? Now, that could be, we've had a couple of clients, let's say this week, one is 70, the other one was 62, that need to have life insurance where they don't need it for personal reasons. They need it for SBA loans or business loans that they're getting. It's a requirement of the loan. Right.
Makes
So these are
sense. Yeah.
individuals that are worth $5 or $10 million. So they're successful in their business world, but with how their assets are structured, this is what the banks require. So that could be a reason why someone needs an insurance policy. The other side of it could be is that you have to look at, again, where your assets are and what's going on. Sometimes we have clients that are a little bit older in their 60s, late 50s, early 60s, and we're using life insurance strategically to solve a tax problem with converting from IRAs to Roth IRAs. And there's a strategy that can go on to that. And then you're tying it into long-term care coverage because you can have a life insurance policy that pays on your death, but you also can access some of that benefit for long-term care insurance. That's been a really popular option for a lot of clients just because traditional long-term care insurance is very expensive and the price keeps increasing on people. So, we use it to be very creative to solve different planning needs. On a younger individual, the biggest thing that I would say right now is, you want term insurance because you want the most amount of coverage for the least amount of money, because typically they're building up their families, they're buying their homes, they're doing all the things that are really expensive right now. I mean, look, I'm 39 years old. I have a wife and 4 kids. I definitely understand how expensive life is in today's day and age.
Right.
So, I have a ton of term insurance. And the reason why I have a ton of term insurance is I manage my cash flow, right? I can't, the amount, you asked a question about like how much insurance you should have and have that process. The first place that we like to start is a replacement of income. Yeah, at a minimum, you want to cover your debt. But realistically, as Jamie mentioned earlier on in this conversation, is we have to replace income. So if you're earning $200,000 a year and you have $1 million policy, you've only really replaced 5 years of income. Now, for some people, that might be enough. For other people, that could be devastating to their family's lifestyle, right? So we would always say, and there's actually a calculation that the insurance companies do to make sure that you don't become overinsured. But based upon where your age is, there's a calculation. It could be 10, 20, 30 times your income. Now, we have to combine that with your assets. And for some people, they might turn around and say, you know what? I don't need to replace 30 years of income. I'm good at 15, or I'm good at 12, or I'm good at 20 because of some different factors. And that's perfectly fine. Let's figure out what's the best number for you. And that's the biggest thing I say for younger couples is just replace your income, your gross income, not your take-home income. I replace your gross income, and then you can start planning from there. And I would be looking at 20-year policies. The 30-year term policies, they're great. There's nothing, there's not the issue from a policy perspective, but what we've noticed over the last few years is that the pricing for that last 10 years compared to the 20-year policy is extremely expensive. So what I would typically say, we have clients that really want like a 30-year term policy. We'll do a little bit of 30-year term. We'll do a little bit of 20-year term, and we'll do a little bit of 10-year term. So you can kind of tier it. So as you start to get older, you may not need as much insurance, and that we save money on cost.
That makes a lot of sense.
Yep. So Terry, there's a couple of things that in John's scenario to work with. One is that you want to work with an agent and you'd say, who do we work with in order to get this? You want to work with an agent who is basically non-captive. And non-captive means is that they can have the insurance companies work to get the client's business, right? So it's a little different. So you're not limited to which carriers you can work with, because at certain times during the year, different carriers have different programs in place to help them push more insurance. The other thing is that you have to look at riders, right? Because you're never going to be any younger. You want an opportunity that in case you're disabled, sick, or injured, that has an opportunity for the insurance company to pay for your policy so you don't have to. And in addition to that, there's another option that is available to convert your policy into your term policy into a permanent policy, because you may be sick or injured, or you may not be able, you're not as healthy as you once were, and you could get basically denied going to apply for a new policy. So there's a lot of different options, but my suggestion always has been over the last 40 years is to be work with somebody who's not limited in who they can offer. Let the carriers work for the client, and make sure that your agent or your professional that you're working with has the ability to do that. So they put you with the right product and that point in time, which is correct for you, your family, and your life.
Yeah, I think that's really good advice. And you guys didn't ask for this plug, but in my experience, a lot of the insurance companies have a lot of very young junior salespeople that are out there trying to solicit business and start their career, and that's great. But I think it's pretty clear the two of you have been there and done that and have a wealth of experience and represent multiple carriers. So you're very consultative in your approach and looking to tailor the right solution for that person's individual and unique needs. So I'll definitely link your contact informations to this video so that people can reach out to you directly. And I guess in closing, is there any other things that we didn't talk about today that you think are important for our audience to know or reflect upon?
So I would say we talked a lot about life insurance, which is great, but I think we also what comes in with love is that we need to talk about the estate documents matching the life insurance policy, and it's something that's often missed, in our opinion, right? Especially when it comes to you talk about younger families, the beneficiaries, right? See, everyone has the "I love you" will, but what happens after there's both spouses pass away? What happens with the kids? And you want your insurance policy on the contingent beneficiary to match up to those documents to make sure that the money's going to the kids, it's not going to the estate, and it's transferred in a way where maybe a trust is set up at that point in time. So that's a really important contingent beneficiary thing that doesn't cost people any money to do, but it matches the legal documents that they're getting set up with you guys. And that's one of the biggest things that we see is that the beneficiaries do not match the legal documents. So whether it's investment accounts or insurance policies, they definitely need to make sure those things are matched up.
My view, and over the last 40 years or so, you'll find that people have a little bit of this, a little bit of that, but it's kind of like your kitchen junk drawer. So you open the junk drawer and you've got the corkscrew, you've got this. Nothing is really organized and coordinated. And it's a process, because the way we live, life happens as a process. So we want our legal documents in order. We want to make sure we're protecting the people we love with the things that we love. We want to make sure that it's kept up to date, so we don't have an expiration date on it. And we want to make sure it's basically done in a holistic format or built in a vacuum. If it's built in a vacuum, that's going to be the optimal way to go forward. Now, we know we don't live in a vacuum, so as these other things creep in, we have to be able to have the experience and the professionals around to handle those risks that weren't there in the vacuum. And we can address those risks in different ways of strategies.
Yeah, you guys both bring up some excellent points. I know what got me into this business in the first place is watching my mom go through losing her husband, and how for a very smart, intelligent, entrepreneurial woman, her life was very scattered from a financial and asset perspective. And so you're absolutely right. Most people, that's how it is. They don't know what they have. Even they don't know where all the things are. If you have a storage facility that has to have monthly rent, and the person that died that has that, you can lose everything in that storage locker if you don't pay the rent on time. So understanding what you have, organizing it all in one place, that's what the Love platform can help you with. And then The other thing that you brought up, which I think is an excellent point, is the inconsistency between your 401k, your IRA beneficiaries, your insurance beneficiaries, and what your estate plan documents actually say. So they've got to be in sync, and that's another area that Love makes sure there's that consistency throughout. And life happens, right? People have kids, they have grandkids, they buy new assets, and so your documents aren't a one and done scenario. You have to constantly update them. And again, that's where Love comes in. We have dynamic estate plan documents. You can make changes anytime without paying an additional fee. So I appreciate you guys bringing that up because that all speaks to the benefits.
Terry, so one of the things I just thought of that I think would be great to do is if anyone who's watching this, if they want to get a written plan, exactly like how you mentioned, and they want to get an analysis of is everything in line, if they send us an email and they just write love, right? LVED, put that in the subject line, we'll walk them through a complimentary framework written plan and we'll put that together for them automatically.
That's fantastic. That's great. And Jamie, I know that Love Financial, which you are a partner of, co-founder of, you offer a bunch of things, not just life insurance. Do you want to just spend a quick second and talk about some of the other things that Love Financial can do for our clients?
Sure. So, I mean, the experiences that we have are, you know, tens of years. So we've been through all the so-called wars and the product wars, so to speak. So it's long-term care. There are different options that are available depending on the state that you're in. It's life insurance, it's disability income, and we do investment through Your Choice Financial, as we're a member of their RIA. So it's really a full-scale operation that we deal with. Uh, that's the way we look at things, the way you've heard me speak today. It's advisory. It's not captive. So at this point, we kind of know the carriers that we deal with and who's to be best suited for our clients at that point in time. So again, it's consultative, and that's the way that we like to work in an advisory consultative platform.
So a comprehensive estate plan includes, organization, putting everything, securing it in a safe place, creating the legal structure to make sure that your wishes are followed and that you're protecting yourself. We didn't really go into probate, but that's a big problem for a lot of people and a lot of families. So protecting yourself from probate, and then where are the gaps in your plan, filling those gaps with different products that can address those needs, like life insurance, long-term care, whatever. And so that would be kind of the perfect estate plan for most families. And that's something that you all can help put together for our audience. Is that correct?
Absolutely.
Well, great. Well, this has been a terrific conversation. We could keep going on and on. I have a bunch of other stuff. We didn't even get into geopolitical issues that are going on right now and all the other kind of topics of the day. But hopefully we can have you both back on and we can continue the conversation. But really appreciate all the insights that you're giving us and our audience. Thank you very much.
Thank you for having us.
Thank you, Terry. Take care.
Yeah.
All right. Take care. Thank you.